Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Jamie Bateman. He is a Maryland-based entrepreneur, U.S. Army combat veteran, former Department of Defense civilian, and host from Adversity to Abundance podcast. And since 2010, Jamie has built a diverse multi-state portfolio of rental properties and mortgage notes and has managed multi-million-dollar mortgage note portfolios while offering opportunities to both active and passive mortgage note investors. So, Jamie, thank you so much for coming on the show today.
Absolutely, Charles. This is going to be fun. I think you covered it all. I think we can just log off.
That's it. We're done. So thank you so much for coming on. So we have so much information here to go over, and it's interesting because you're a mortgage note investor now. However, you were also a real estate investor prior to everything else. So if you can tell us a little bit about yourself, both personally and professionally, prior to getting into investing in real estate itself, and then also notes.
Yeah, absolutely. I definitely spend the majority of my professional time now on mortgage notes, and we'll get into that. I still hold the rental property portfolio. And so, my focus has shifted, but I wouldn't say, it's not like I got rid of rental properties, and because I still feel that they have a strong position in real estate investing. And I do think mortgage note investing technically is real estate investing. You can argue it whether it's more like finance versus real estate, but yeah, personally, we chatted briefly beforehand. I played lacrosse in college, and that was a huge part of my life. And then there was a huge void after college, as far as not being plugged into a team or serving a greater purpose, if you will, not having that mission. And so I think, like a lot of listeners can relate to, I didn't honestly really know what I wanted to do. I mean, I had obviously given it some thought. I did some coaching in lacrosse, did a few different things in the fitness world and different things, trying to just figure out my way, and eventually landed my first quote unquote real job. And that was at a title company. And I realized quickly how little I knew about real estate and, closings. And I ended up doing a lot of refinances as a notary, driving around the state of Maryland, specifically doing a lot of the closings and having to explain all the documents to borrowers when the refi boom was happening in 03 to 05. And that time frame is when I was doing that. And then I worked for a mortgage broker, and then eventually I joined the military, really again for that kind of greater purpose and trying to be part of something bigger than myself is really what it was. Served in Iraq, did about 4 years of active duty time within the 8 years that I was in the Army Reserves. Fast forward, that led me to a civilian role at the Department of Defense at Fort Meade. And I worked for 14 years as a civilian with DOD. The first 7 years was full-time, and the second 7 years I was actually able to work part-time for the government, and was able to maintain benefits, full-time benefits for my family and me, while working part-time, sometimes 16 hours per week. And we can get into that. That enabled me to have a kind of a slow rip off of the Band-Aid, if you will. And then some things fell into place where, really some adversity occurred. Not only COVID, but also got injured and was away from work for a period of time. And that's when I realized I can't do this job anymore. I can't do this W-2 anymore. My heart wasn't in it anymore. So about 4 years ago now, I quit my W-2 and was able to rely on real estate full time. So there's a lot there that we could dive into, and I know we only have so much time, but a lot of this, there were several inflection points, I'll say, over those years that I've covered with regard to, mental and mindset shifts as well. And realizing that I wanted to take ownership of my own financial future. And instead of focusing on just the obstacles and why, I can't make it or I can't do it, or, what's the cards are stacked against me in this way, I shifted toward, no, this is what I have going for me. These are the people who are in my camp or on my team, so to speak. And that was very helpful to enable me to move, to quit my W-2 and do real estate and mortgage notes full time.
No, thank you so much for sharing. And yeah, I mean, I was going to talk about it a little later on, but I'd love to bring it up now since you've been talking about it, is the you have a lot of, I guess, entrepreneurs in general, and then real estate investors. They start off with a W-2, and I mean, it's a balancing act. Doing a whatever it is, it's another business, or it is a job, or whatever it is, and then also being able to successfully begin a real estate investing business. So, kind of, how did that work for you? And what would be, I guess, the other thing is like advice to people that are a few years behind you?
Right. Number one, this is the caveat, so there are several caveats, but there's no one size fits all answer or situation. Everyone's goals and experience levels are different. Every situation is different. That said, um, we purchased our first rental property in 2010, as the bio mentioned, and that frankly we did have some capital kind of fall, a little bit of a windfall there that helped us get started. Um, so that was, I mean, I had no goals of quitting my W-2 at any point during, in 2010. That was strictly, hey, I really want to have some other source of income here. I want to not have all my investment in the stock market. I like alternative investing. So I wasn't intending to, start toward quitting my W-2 anytime soon, but we purchased a condo as a rental property, and honestly, we have the same tenant in there now, and that's been amazing. I put up a Craigslist ad. I really had I had no clue what I was doing. I mean, my father was a real estate agent. My brother is a loan officer, and I'd worked at a title company, as I said. So I felt comfortable in the residential real estate space, but didn't really know what I was doing as a landlord. So we started with a condo because there's the condo association, there's less exterior maintenance, or really none, and theoretically it's easier to be a landlord with a condo versus single family, or even certainly a multifamily complex. Dabbled, got our feet wet in that way, and then it wasn't until 2015 that I really said, I want to do this more. I really want to scale this. Advice is tough. A lot of people say, I want to get my rental property or my real estate income. Once that matches my W-2, then I can quit my W-2. That does sound good, but the thing is, when you quit your W-2, you're losing your W-2 income. So like, you're always going to have a loss in income when you quit when you take away a source of income, right? So, there's never, I guess the advice would be, there's never a moment where all the stars align and now is the perfect time to take action. So in general, the advice would be, okay, get educated. Don't just jump in with, hastily, but on the flip side, don't use that education as an excuse, that need for education as an excuse not to take action. So get educated, but don't be afraid to learn as you go. And, you need to take action and continue to learn through the entire process.
So once you started in 2010, kind of how did your real estate, what was the progression from buying some rentals? I mean, did they get bigger? Did you change strategies anywhere through that before transitioning into, ultimately notes?
Yeah. So 2010 to 2015, we just had the one rental property. I had the one condo. 2015, what it was I hated the Groundhog's Day. I mean, I had a family with kids, and it kind of like the same old, you get up, commute, work your day job, commute home. I had a fairly long commute, and I'm just, it just got old, so it's like, what can I do to to get rid of this pain, basically? So I started listening. I said, well, I have this long commute. Well, why don't I listen to podcasts? Right. So I listened to Bigger Pockets and many other podcasts to fill that time. And honestly, there were many days where I kind of wished my commute was longer because I was so into the show. So I was learning, just soaking up so much knowledge, was reading so many books and things. And so at some point in 2015, the first half of 2015 or so, I really started to take a lot more action. And what we started doing was, in essence, the Burr method, which may not be the best move right now, best strategy right now, given market conditions. But at that time, it was working, where we would buy a rental property, fix it up, put money into it, raise the value of the property through forced appreciation, rent it out, refinance, get our money back, and rinse and repeat. So we were doing that with what are considered row homes or townhomes in the Baltimore area, Baltimore County specifically, without HOAs actually. So townhomes that essentially were the same, almost the exact same house over and over and over. And so I understood, it wouldn't be hard if I needed a water heater on this property. I'd already done it on this property. I self-managed for several years, 2015 to 2018-ish. And that's about when I brought on a property manager. And in 2018 is when I pivoted to mortgage notes. And again, when I say pivot, I didn't turn my back on rentals. I just added mortgage notes to my investing strategy and shifted my focus to mortgage notes. So I've always been in the residential real estate space. I have invested as a passive investor in some multifamily syndications, as I know you're very familiar with, Charles, and some other opportunities as well as an LP or passive investor. But as an active investor, it's always been the residential rental property space or residential mortgage note space.
So you self-managed for 3 years. I self-managed my properties for 6 years, and maybe that was a little too long, but there's a lot of information and there's a lot of education and experience that I received through that, which I wouldn't be able to get from any other means other than doing it. And what do you think about that? I know that's not your business per se now, but you still have investments in it. Like, what do you think if you were talking to someone that wanted to be a rental investor? What would you say if they asked, should I self-manage or not?
I think if you have the time, you should do it. I think there's, like you said, there's a ton of education that you just won't get through a book or a podcast, or you may try to get it elsewhere, but it just doesn't have the same meaning when you're the person, you're doing it. So you're screening tenants, and residential and commercial rental property management really comes down to kind of two things. It's property maintenance and then leasing. And it's kind of two different hats you're wearing, if you will. And there's so much to learn on either side. And so I find that residential rental property managers fall into kind of one of those two camps typically. They were either a contractor where they were, doing rehabs and construction, and then they were like, I can manage properties as well. Or they were more of a real estate agent where they're very good at, listings and finding people to buy and sell homes. And so, well, I can do this on the leasing side, rental side as well. So it's more of like the property and the people combined. So many lessons learned. I'd highly recommend that the listener, if they're getting into rental property investing, do it yourself at first. Maybe don't do it forever, because that's kind of the point is for a lot of us is we want to make this more passive as we get older, and it's not necessarily what we want to be doing, changing, working on a clogged toilet or whatever at midnight. But I would highly recommend it if you have the time to do it.
Yeah, I like how you said more passive, because it's one thing I think it's like, I call it semi-passive. You bring on a property manager, it's semi-passive.
There's nothing passive about this. I mean, and there's so many people that it's clickbait, and I do have passive. I offer passive investing with our fund, the Integrity Income Fund for accredited investors. I mean, that's pretty passive, like you said, but it's like, you still got to do something. And so I have people could check it out. It's for the cash flow. I've done a couple presentations on the same topic where it's called the spectrum of passiveness, or is note investing actually passive? And the reality is it's not either or. There's a scale, there's a spectrum of passiveness or passivity, and you can make it really passive or you can make it really active. And there are many ways to do real estate and notes within that, on that spectrum.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. All right, so let's get into kind of what you're doing with your note business now. Can you give us kind of a little bit of an overview of what your note business is and kind of like what your buy box is with these notes?
Yeah. So the note business, we offer solutions for both the passive and active investor. For the passive investor, they need to be accredited, and your listeners can Google that if they're not sure what that means. We have a fund called the Integrity Income Fund that offers passive investing, passive preferred returns. We do monthly distributions for those passive investors. They, once they're comfortable with placing capital into our fund, honestly, they really don't do a whole lot. They get a monthly distribution. I sent the funds out this morning for July 1st. We're always ahead of time. And so those are for our passive investors. I also offer mentorship for the active investor who wants to learn notes or who wants to take their active mortgage note investing business to the next level and scale that. Just to kind of zoom out a little bit, mortgage note investing, just like, multifamily investing and many other real estate niches, it really breaks down into three different legs of the stool. One leg is raising capital, because even if you're, have $5 billion, maybe you don't want to put $5 billion into mortgage notes. You probably are going to run out of your own capital that you have allocated for mortgage notes. So finding access to other people's money is part of this. And these are in no particular order. The second leg of the stool is finding deals, finding notes, sourcing notes to buy. And it's, again, same thing with a multifamily project. There's a property you're buying, right? And the third element, the third leg of the stool, which is the most time intensive for us, is managing those two, managing the capital and managing the notes. And so we offer solutions for both the active and passive investor. Our buy box, what we really focus on, and this is really my wheelhouse, is first lien mortgage notes. They tend to be in the $50,000 to $150,000 principal balance, range, if you will. We buy often in the Midwest and Southeast, and there are pros and cons to different states and different purchase prices, different real estate principal balance ranges. Mortgage note investing is extremely state specific, and a lot of that has to do with judicial versus non-judicial foreclosure processes. We've purchased in probably 25 states. So our buy box has expanded over the years. We have the Integrity Income Fund is a reperforming note fund primarily. So what that means for the listener on a high level is that there probably was some issue at some point in time with the pay history on this loan. It doesn't have a perfectly clean, we're not talking about borrowers or homeowners with 800 FICO scores that have never missed a payment on anything. We're talking about maybe 650 or 600 even, and maybe they lost their job 3 years ago and now they're back on track, or maybe we helped them get back on track. And so the loan is now performing again, whether that was after we purchased it or not. And so the majority of the loans that we own in our fund are reperforming note funds. I've also run a non-performing note fund where the whole goal is to buy non-performing notes and add value to those notes, exiting through the property or the borrower and selling those notes or exiting the note in some way for a profit. We do own non-performing notes in our current fund, but the majority are reperforming or even just straight performing notes. Back to the buy box more specifically, we do buy land notes. We do occasionally originate loans on sometimes land or commercial property. We have also purchased fix and flip or rehab loans, but the majority, I'd say 90% of the loans we own or purchase are first lien owner occupied mortgage notes, primarily in the Midwest and Southeast. And our goal really is to keep borrowers in their homes, and that's typically the most profitable exit strategy. So happy to dive into any of that in more detail.
Yeah, first off, can you explain the two different states, types of states that we have and how that affects your business? So people, because I kind of might have went over.
Absolutely. And then all of this gets very nuanced, and this is where it's like a mentor can really help you, shorten that learning curve. And yes, it's self-serving. I have a mentorship program. You should reach out to me. to, schedule a call about that. That said, you should get a mentor, whether it's me or not, because you can jump into mortgage notes without any kind of education or help, but maybe you shouldn't, because this is very nuanced. And so, to answer your question, most states fall into either judicial or non-judicial categories, and the from a high level standpoint, the judicial states use what's called a mortgage. This is not always true, okay? But the judicial states have what's called a mortgage, and in non-judicial states, the document that attaches the note to the actual collateral or the house is typically called a deed of trust. So in a judicial state with a mortgage, the foreclosure process goes through the courts. And in a non-judicial state, typically with a deed of trust, the foreclosure process is done through outside of the courts and is less expensive and less time consuming. That results in higher prices when purchasing notes, and that's not the only factor that leads to those higher prices. But typically, a state like Texas, to give you an example, is a super fast non-judicial foreclosure state. You can get a foreclosure in a month or two if everything lines up correctly. In New York and probably Connecticut, where you're from, and also Florida, where you are now, they're judicial states and they're much more time consuming, and you can get better pricing on purchasing those notes, but you're going to spend time and money going through that foreclosure process. And so because everything goes through the courts, and borrowers tend to have more rights.
Sure. Well, thank you so much for explaining that. But when you were talking about sourcing notes, that was one thing. Can you tell us how you would source notes in these kind of your target markets throughout the Midwest and the Southeast?
Absolutely. Sourcing notes is really the big $1 million. It's the $1 million question. It changes. It's a relationship business. It changes over time. We have a list of sources. We also did, for your listener, we just put out a free PDF that talks about how to use AI to source more notes. Obviously, I'm not going to go into all that now. We also put actual sources of notes in that PDF. You can find that on our website, labradorlending.com. But it's never ending. That PDF is going to be obsolete in 6 months. And so there are sites like paperstack.com. There are other online exchanges where you can find notes to purchase. The best way to find notes, however, is just networking and talking to other note investors. A lot of times we're buying some notes now, and we're buying notes from 3 different sources right now. And all 3 sources are existing note investors that I just happen to know. And and I've purchased from before, at least 2 out of the 3 I've purchased from before. So it's a relationship space. Doing due diligence on your note seller is probably more important than doing due diligence on the note that you're buying. So we have a list of sources. The number one piece of advice I could give to the new note investor is to reach out to other note investors. Have your buy box ready to go. And that's one thing we work on with our mentorship program, is defining your buy box, developing that buy box. Because if you don't know what you're looking for, you're not likely going to get it. So you need to have your buy box well established so that you can present that over and over and over to people and say, hey, Chris 70, I know you sell notes sometimes. He's another note investor. I know you've had him on the show. Chris, this is my buy box. This is what I'm looking for. He's not thinking about me and my buy box when he goes to sleep every night. So you need to ping him, as I'm using him as an example, every month. Hey, this is our buy box. This is what we're looking for. Do you have anything that you might be selling? Oh, yeah, actually we do. So it's very inefficient. It's not the New York Stock Exchange. It is, it's a relationship business, and developing those sources over time takes work. And it changes. The sources dry up and new sources pop up. So, yeah, that's the in the time we have, that's the best answer I can come up with.
No, it's perfect. When you talked about obviously just doing due diligence on who you're buying it from, can you go over a little bit about the due diligence on the actual note? Or maybe if you're buying this from someone, what I see is I'll speak to people and they're doing like seller financing deals, and it's just how they have an attorney that's never done it before and all this kind of stuff. And I'm like, and they're like, oh, you can always sell that debt on this, on the second market or whatever. And you're like, well, I don't know. I mean, I just find that if it's not put together correctly, can you tell us a little bit about like that due diligence on notes and then also buying notes that might be from seller financing deals?
I mean, this is such a critical point. You made multiple great points there, and that you see this so much now, given our market conditions, and frankly, with the gurus that are out here promoting certain specifically subject to and different things. We don't have time to get on into the nuances there, but it is a critical piece to think about. If you are originating a note, well, yeah, you might think it's a very short term thinking. You're just, oh, I just want to originate this note and hold it, or I want to like sell it immediately. But you don't. Not everyone thinks about what makes a note marketable. So put yourself in the shoes of the buyer of that note. What are they looking for? Oh, well, they have a due diligence process like you talked about, Charles. And what's their buy box and what makes a note marketable. So as far as making a note valuable when you create it, and if you're doing seller financing, one is go through an underwriter. Call theunderwriter.com. Dan Deppen, who's a friend of mine, he runs that now. That's a great resource to go through to make sure that you have the main goal there is to prove that your borrower has the ability to repay. So you're meeting the Dodd-Frank requirements there on the underwriting side of things. Each state may have specific guidelines and things as well. And the Fannie Mae website has free documents for people to pull, templates of documents to use. So that's another good resource for your listener. But they need to be in compliance from providing that evidence that the borrower has the ability to repay based on their income and expenses. And so if that is true, and if the loan was originated through an underwriter, through a mortgage loan originator / underwriter, like calltheunderwriter.com, you can, that adds a lot of value to the note. So if I'm looking to purchase a seller finance note, that is one of the questions I'm asking right away. Was this properly underwritten to meet Dodd-Frank requirements? Now, I will tell you, if this loan was originated 15 years ago and there's a strong pay history, I don't really care so much about that anymore. We, on the buy side, with our own due diligence process, whether it's purchasing a seller finance note or an institutional note that was bank originated or originated through a more traditional lender, we have a very thorough due diligence process. And again, not only is building the buy box one of the things we work with mentees on, but building your due diligence process is also something we work on. People can copy and paste my due diligence process, but it may not be the right one for them. So on a high level, Charles, what we're looking at in our due diligence process are three things. People call it the 3 Ps: the property, the payer, and the paper. The property, that's our collateral. So we need to really do our best to verify that property value. That's the main thing we're trying to do there. And one of the risks with note investing, and I don't shy away from talking about the downsides of note investing, is that you don't typically get inside the property on an owner-occupied note. That someone's living in there. We're not doing a full appraisal. We don't really know the condition of the interior of that property. That is the fastest way to lose money in this space, is undervaluing that property, which I've done before. The second piece is the payer, and that's where we're looking at credit score and pay history on the loan, and also maybe the conversation log between the loan servicer and the borrower. That tells a story of that person's situation. What's their income? Where do they work? What are their social media profiles like? What's their situation? Did they just lose an income? Was it a married couple who just lost an income, or maybe they had a death in the family or something? Or so that payer is, researching that payer is critical. And then the third piece is what we call the paper, and that really gets to, largely it's the collateral file. So we're talking about things I used to deal with as a settlement officer with the title company, where you're talking about the actual note and mortgage, the assignment chain, a launch chain, things like that. That's the collateral file. There are other quote unquote papers involved in that paper category. We probably have a 25-step process that we use to go through our due diligence checklist, but every step would fall into one or more of those 3 P categories.
What is your target hold period for one of the notes? I mean, what do you think you average?
Yeah. So this is where I'm going to have to give a cop-out answer and say it depends. It really depends because we're not primarily focused now on non-performing notes, although that's likely to shift here in the future. So I'll answer it from a non-performing note standpoint, where the borrower is not making payments, or if they are, they're way behind. In those cases, our target hold period is probably 18 months. It can be 4 to 5 years, and we've also exited notes in 2 months that were non-performing. So 18 months is a good kind of median, if you will. I would say it's longer than a fix and flip on a residential property. Typically, you need to be ready if you're buying non-performing notes. You need to be ready to have that capital tied up, and possibly have to put in additional capital for property taxes, legal fees, etc., for 2 to 3 years. So on the reperforming note side, we're holding for cash flow, and we do monthly actually go through and see which loans have some profit sitting there that if we sold them today, what could we make? But I'm also okay holding those reperforming loans for perpetuity, if you will, because they're providing cash flow. So if your goal is to put money to work and work those loans and really put some quote unquote sweat equity into this, then you should probably be buying non-performing notes and be ready to have your capital tied up for 18 months to 24 months, or not longer. On the reperforming side or performing note side, that's a long-term play, just like a residential real estate rental property. I don't have an exit strategy there. I'm buying to hold.
Yeah, until they refinance or sell or something.
Yeah, and a payoff, and that's a great point. Quickly, we're buying at a discount regardless of the loan type. So if I get a payoff, I've only purchased one loan at par, and meaning the principal balance is what I paid for it, and the reason was it was a 15% coupon rate. So, but in general, we're buying at a discount. So even these performing loans, we buy at 90% of principal balance, maybe even 95%. But if I paid $95,000 today, and then next week the borrower refis, as you said, I'm getting that at least $5,000 in profit back. So if I get a payoff, that's always good.
Just because you brought it up, and this is gonna be difficult because it's on a per case basis, I would imagine. But okay, so you had one. If it's performing, you're getting a slight discount, usually I would imagine, from the principal, and then the value, and then reperforming, I guess it's a little bit more of a discount, and then non-performing, I imagine there's a dramatic discount. Is that kind of how it works?
Yep, absolutely. And the pricing has gone up, just like you're a multifamily investor. Real estate investing has been tighter and tighter. So since I've gotten into the space 7 years ago, it's the discounts have shrunk. Okay. That said, yes, we're talking probably 90 to 95% for a strong performing loan. More closer to 80 to 85% for a reperforming loan and we're talking of principal balance here, just to keep things simple. And on a non-performing loan, again, depends on the state. It really does quite a bit, but you're talking 65 to 75% of principal balance, maybe even of the full payoff there, for a non-performing loan. Many factors besides just the state, but the property value, how much equity is in this. Another huge factor is what we call the coupon rate, the interest rate on the note itself. That's a massive factor. So when actually, even though we're talking now about percentage of principal balance for the purchase price, when the loan gets more toward the performing side, I don't even care as much about that from the buying standpoint. I care about my yield. So looking forward, what is the yield that I'm going to get from a cash flow standpoint? And we tend to target for my fund, I need a 13% yield or greater to make the numbers work. But you may be perfectly happy as an active note buyer with a 10% yield with lots of equity in Texas, just as an example. That's not a bad investment, so it depends. The yield is what I'm focused on with performing notes, and we will check the percent of principal balance as well, but it's secondary if the note is performing.
Before we start wrapping up here, I just had one more question in regards to servicing, because you mentioned it. And I imagine if I'm buying a performing note, it doesn't really matter. The person's just sending their money from place A to place B. But when you start working more hands-on, especially with non-performing and possibly reperforming notes, if you have to get them back on track again, how does that work with servicing? Are you doing that servicing in-house, or
So I highly recommend that note investors in general use a licensed loan servicer. If we're talking owner-occupied debt, where this is a loan that was originated to a homeowner, not for an investment purpose, we use multiple licensed loan servicers, but on each loan we have a licensed loan servicer who their primary role is to keep everyone compliant, specifically the lender or note investor, and then to collect funds and disperse those funds to the investor. And so, yes, it's a critical piece. Doesn't mean you have no responsibility as an investor to look up. And I know I've done probably a good bit of plugging on this show, but we also have a free resource on the state licensing guide. Okay. And there are several states that do require licensing, regardless of whether you use a licensed loan servicer or not. You can get that PDF from my website. But yes, you should always, if you're talking owner-occupied debt, mortgage debt, you should use a licensed loan servicer. The way to think about their function, they're like a property manager on the rental side, except there's a lot more licensing requirements. This is a financial service. And so there's so much licensing specifically on the state level. It's a lot, trust me, to get involved with on the loan servicing side. So I highly recommend you use a licensed loan servicer. They interact with the borrower. They keep everyone compliant. There's certain things that you can or cannot do with reaching out as a debt collector. And it's worth paying the $25 or whatever it is per month, depending on the servicer, to use their services and stay compliant as an investor.
Yeah, no, a lot of great information there, especially if you're working with people that are, it's their residence, because that's a whole different ballgame versus a hard money lender. You know what I mean? You're like flying by the seat of your pants a little bit, and it's not really a problem. Okay, before we wrap up and we get information on what you're doing, what advice, what would you say some common mistakes are you see real estate investors make? Note investors specifically.
Yeah, common mistakes are working with, not doing due diligence on the person you're working with or buying from, or, I'm not even talking about starting a business. I'm saying, with a partner, I'm saying purchasing a loan from someone. So just ask another experienced note investor or mentor, what have you heard about this person? Are they trustworthy? So dealing with people who are not trustworthy in the space, unfortunately, there are always a few bad apples, and we have this in note investing. In general, the space is very helpful, lots of really good people in it. But not doing the proper due diligence on the people you're working with or doing a transaction with, that's a big mistake. And just, I guess undervaluing that property value. So not doing enough due diligence on the property itself. Is really where you can run into a lot of where I've lost the most money on, particular deals is not understanding that property value. And so don't be afraid to just hold off and say no to a particular deal. And, don't get so hung up on yield. Okay. Don't get so as much as I said yield is very important, it is for sure. But I'm saying don't get caught up in, I need a 20% return on this deal. No, be okay getting a 10, 11% return and making a slightly safer investment where there's equity coverage and you're working with, transacting with people who are trustworthy. There are many other mistakes people make. I could throw in quickly the one I see a lot, where we have a lot of engineers who come into this space and they run numbers and they do pro forma calculations on hundreds of deals. And this is a blanket generalization, sorry, engineers, but then they don't take action. It's like, you got to take action. So that's a big mistake. But another big mistake is jumping in, not defining what you want. What are you, are you looking for cash flow, or are you looking to put your capital to work for a long period of time, and then jumping in too quickly? So there are a bunch more, but I think that's good for now.
Yeah, no, that's perfect. Thank you very much. I appreciate all that information. Yeah, the returns is something you'd hear getting calls with investors or potential investors, and they're comparing one investment to another investment just on rate, and you're like, or just on return, and you're like, this is a game we can't win.
Right. Exactly. And I will say, note investing, if you're getting into notes for the return, obviously we need a good return. But if you're trying to get into this space for comparing to like the returns you could get with crypto or oil and gas or something, don't be a note investor. You're not going to get those returns here. That's not why you get into this space.
Well, Jamie, thank you so much for coming on today. Let's learn more for our investors, people listening, how they can learn more about you. They can talk about your mentoring and also the funds you have going on.
Yeah, thank you, Charles. I really appreciate this. You've obviously prepared very well, and it's been a really good experience. I hope I added a little bit of value to the listener. LabradorLending.com is our website. We do, as I said, mentorship for the active investor. We have a 74-page ebook that's free. You can read through that and decide if note investing you think might be a good fit for you. We have a lot of other resources, blog posts about the pros and cons of note investing, different types of note investing, et cetera. I mentioned the 2 free PDFs, how to find sources with AI, and then the state licensing guide. So LabradorLending.com is our site. You can find everything. Bateman James at LabradorLending.com. Not supposed to throw out too many contact points, but one other I'll mention. My podcast is adversity2abundance.com. It's the number 2, adversity2abundance.com. So those are plenty of resources can be found on those sites.
There's a lot of information on his website, so look forward to checking that out as well if you're interested, and looking forward to connecting with you here, Jamie, in the near future.
Sounds great. Thanks a lot, Charles. Really appreciate the time.
Thank you. Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.